Hello everybody, this is Philipp Jonas for Kalamazoo Valley Community College, and in today's lecture we're going to discuss the monetary system. Money is one of those great regularities of our life. Almost every day we have some interactions with money, and as a consequence we have quite a bit of an intuitive understanding of it. But before we discuss the monetary system of the United States, let's start out discussing what exactly economists mean when it comes to the term money. So the easiest way to explain this is to think about an economic system without money, in which we're trading goods and services with one another directly. This is referred to as barter. And while you can trade using barter, you very quickly run into a limitation. For barter to be successful, each party needs to have something the other party wants. We refer to that as a double coincidence of wants. And those are relatively rare enough that it becomes difficult to build a thriving economy. So sooner or later, every trading system grows to the point where it introduces a special asset that everybody is willing to accept in trade, even if they don't want the asset itself, but because they have confidence that they can trade this asset on for the thing they actually want. This type of special asset is what we refer to as money. And you already heard a key term when it comes to money in that description, and that's the confidence that you need that you'll be able to trade it on. So in order for an asset to elicit this consequence and to work as money, it needs to be able to successfully carry out three basic functions. The first one is the most obvious and easiest to understand. It needs to be a medium of exchange, which means you can take it places and have confidence that this is an item that people will take in trade for goods and services. But that by itself is not enough. For an asset to be successful as money, it also has to be a unit of account, meaning it needs to be able to easily express the value of prices and debts. If we look at our money, the US dollar, that's fairly obvious how that works. There's literally a number printed on the bill, and everybody understands that a bill that has a 5 on it is worth as much as 5 bills that have a 1 on it. But imagine, for example, that we were trading in gold. This is still possible, it has happened throughout history, but now it's a little bit more difficult already, because now we have to express that price in the weight of gold, and then we have to look at the purity of the gold that we're being paid with. And finally, there are some things that are very valuable, like diamonds, for example, but there are so many dimensions to their value that it would be really difficult to express a price. That's unit of account. And then finally, for an asset to work as money, it also has to be a store of value, meaning we're willing to accept it in trade even if we're not going to spend it for a little while, even if we're not going to spend it till down the line, because we have the confidence that its value will be relatively stable. One of the key aspects of the US dollar and all modern monetary systems we'll discuss in the next lecture is that we vary how many units of our money exist in order to achieve that stable value. So these are the three functions of money. An asset that fulfills all three of them would be referred to as money. Of course, in our lecture, we're mostly going to be talking about the US dollar, but in general, there are two broad types of assets that are able to fulfill these three functions. Some of them we refer to as commodity money. These are assets that are not only used as money, but also themselves are a valuable thing if they were not used as money. Classic examples would of course be gold, or for example, cigarettes in a POW camp. If you look at a cigarette, it's got a very standard size, so it's good as a unit of account. It doesn't spoil easily, so it's a good store of value. And as long as everybody in the camp accepts them, it works as a medium of exchange. But that's only one type of money. Nowadays, modern currencies are of the second type, fiat money. Assets that are used as money, but if they weren't, they wouldn't have any value at all, because by themselves they aren't valuable. The US dollar and all modern currencies fall into this category. And once you understand that the dollar works because we can use it as money and because of our confidence in it, there is a whole range of questions we have to answer in order to be able to understand our monetary system. So let's start right at the beginning. If these dollars don't have intrinsic value, the first question we have to answer is, well, what all counts as a unit of money then? What all counts as a dollar? The answer to this question is referred to as a country's money supply, or sometimes money stock. Based on our discussion so far, we could be tempted to give an easy answer here and say, well, dollars take the form of bills and coins, of currency. And since we print and mint these bills and coins, we know how many are in circulation. Let's count them all up. There's our money supply. But we'd be missing a major part of the picture here. Think of all the money you have spent in the past month. Now, if you think of that as, let's say, a pie chart, what percentage of that money you spent did you spend by handing somebody bills or coins? Not that much, right? Most of our transactions instead take the form of checks or debit card transactions or credit card transactions. They take the form of money moving from one account, essentially an entry in a computer, into another account. And all these numbers in the computers, we can count them. They keep their value the same as the bills and coins, and we can spend them. So check, check, check. They too count as money. So let's talk about those bank accounts. The most basic bank account that can be used as money we refer to as a demand deposit. That's a bank account out of which you can directly pay somebody, such as by writing them a check. You might think of these as checking accounts, but not all demand deposits are called checking accounts. They might have other names, like, for example, a share account. So a first measure of our money supply is what we refer to as M1. Here, we count the currency, of course, that counts. We count those demand deposits, and then two smaller technical items. One is called traveler's checks. That's a secure type of check where the money is kept in a separate account with the bank, and some other deposits that aren't technically demand deposits, but in a roundabout way you can still write a check against them. So we put them into this category as well. And if we add up all these numbers, the currency and the bank accounts, we get a number. For example, $3.9 trillion as of January 2020. But perhaps even that is not counting enough numbers yet, because we also have bank accounts and similar accounts out of which we might not be able to directly transfer money, but it's very easy to get at nonetheless. We add these types of entries to M1 to arrive at the measure of the money supply called M2. The obvious big example here would be a savings account. You can't write a check against it, but how hard is it to get that money into your checking account so that you can write a check against it? Nowadays, take out your phone, hit a button, and typically you are there, as long as you don't do it too many times a month. And there are some other things that fall into this category, such as, for example, time deposits, certificates of deposits, as long as they aren't too high in value, and a very special type of mutual fund called a money market mutual fund. That's a mutual fund that invests only in very short-term bonds and whose objective is to always maintain a value of $1 per share. If we add all of these accounts together, we get a very different number, almost 4 times as big. So if this was a lecture in a course on monetary economics, we could now have a good discussion on which of these two measures is better in the case of the United States. Spoiler alert, M2 is the correct answer. But for our purposes, we will not make a big deal out of the distinction of M1 and M2, know their definitions, and then we'll generally refer to these as the money supply of the United States. So that's the answer to the first question. If the dollars don't have intrinsic value, well, what all do we count as dollars then? There are more measures of the money supply we will not discuss in this lecture, such as M3 or MZM. And by the way, notice, for example, that credit cards don't show up directly in any of these definitions. That's because if you pay with a credit card, what's actually happening is that the credit card company is paying out of their bank account on your behalf. So we're already counting their bank account as part of the money supply, and then you have to pay them back at the end of the month. The next question that arises, well, if it doesn't have intrinsic value and if all these entries in bank accounts count as well, then where does the money come from? With a commodity money, that's more obvious. If we were trading in gold, well, gold is in the earth, you build a mine, and then as you dig it out of the earth, that's the source of your money supply. But with fiat money, money that's created by decree, you instead have an institution that takes the place of this gold mine. An institution that decides how many units of money to add or subtract from the system. This type of institution is referred to as a central bank. And changing how many units of money are in circulation is referred to as monetary policy. Now, these are the general terms for what this institution is and what it does, and many countries refer to their central banks as a central bank. For example, how many euros are in circulation is controlled by the European Central Bank, the ECB. But in our case, the United States, our central bank has a bit of a funny name. It's called the Federal Reserve, or sometimes the Fed for an affectionately short term for it. That's because our central bank has a slightly less central structure than most. But it's still accurate to say that it is the central bank of the United States and conducts the monetary policy in our country. So let's have a look at this Federal Reserve. Technically, it's a Federal Reserve system. That's because while it has a board of governors overseeing it, 7 members total, 14-year terms each, rather than this board of governors overseeing one central building, so to speak, there's instead a system of 12 regional banks spread throughout the United States. If, for example, you look at a check for your checking account, if that's with a bank as opposed to a credit union, the routing number, the first 2 digits tell the processor of the check to which of those 12 regional feds it should be routed to be cleared. But that's enough about the system. What we really care about is the part of the system that makes monetary policy. It is referred to as the Federal Open Market Committee, or FOMC for short. And it consists of the Board of Governors as well as a rotating set of 5 of the presidents of these regional feds. And together, they make the monetary policy of the United States. Now, this is a committee, and as committees do, the committee has a chairperson who, at the time of this video, is Jerome Powell. Sometimes in the media for shorthand, whoever is the chair of the Federal Open Market Committee is also referred to as the head of the Federal Reserve. So that's the source of how many units of dollars exist. But there's more for us to learn, because it turns out it's not as simple as the FOMC adds dollars or subtracts dollars from our economy, and that's how many dollars exist. The fact that we have a banking system also influences how much money is in circulation. Let me explain. The technical term for the type of banking system we have is that it's a fractional reserve banking system. That's a very large term, sometimes a little intimidating, but all it means is banks make their money by taking part of what's deposited with them in checking and savings accounts and lending that out for interest. For example, as a mortgage for somebody trying to buy a house. So what that means is that not all of the money in the checking and savings accounts actually stays with the bank. Only a fraction does. This fraction that's not lent out is referred to as the reserves of the bank. Now, in our case, the Federal Reserve establishes minimum requirements of how much the bank has to keep in reserve, which, overlooking a number of technical details, is roughly 10% in the case of the United States. That's the minimum, the so-called reserve requirement. What the bank actually keeps in reserve, we refer to as that bank's reserve ratio, or capital R for short. However much is deposited, the fraction of that that's not lent out, that's the reserve ratio of a bank. Let's have a look using a simple example of how this works. And in order to express this, we're going to represent a bank as a T account. Now, if you've already taken a course in accounting, you know what a T account is, and you're probably a little disturbed that this is showing up in economics right now, but don't worry, we're going to do a super simple version of a T account. A simple 2-column statement of a bank's assets and liabilities. And if you've never seen a T account before, here's the version of a T account we're going to do in our lecture. So it's called a T account because we have 2 columns here. In the left column, we put all the assets of the bank, and in the right column, all its liabilities, to whom those assets are owed. And the magic of the T account is the sum of everything on the left hand, the assets, has to equal the sum of all the liabilities. So for example, here we have a bank that has $100 in deposits. That's a liability. Whoever has that deposit might show up and want their money back. Then the bank can do 2 things with it. It can make a loan. It has $90 outstanding in loans. That's an asset to the bank. And whatever is not lent out is the reserves of that bank. In this example, $10. So left side, $100. Right side, $100. So here's an example of a bank. Now let's go ahead and calculate the reserve ratio of this bank. It has $10 in reserves and owes $100 in deposits. That means as a fraction of its deposits, its reserve ratio is 10%, which in the case of the United States would be the legal minimum, but it's also a very convenient number, 10%, so we're going to keep using 10% as an example. Now let me show you why understanding a bank and its reserves and loans is so important for understanding the money supply of a country. Imagine we are putting $100 of brand new money into circulation. So we're the Federal Reserve, we're creating an additional $100. We haven't yet discussed how the Federal Reserve puts money into circulation, so for the sake of argument, let's just say we print this as a physical $100 bill, we just fly over the United States, throw it out of the side of a helicopter, and then whoever fetches the $100 bill, they're the lucky ones, they get that brand new money. Let's discuss how this plays out in 3 different cases. What if we didn't have a banking system? It's going to be a very basic case, just to make sure we understand the story. Then let's look at what would happen if we had a banking system, but not as we understand it today. Let's say we had banks that were forbidden from making loans. Everything that's deposited has to stay in the bank as a reserve. It turns out such a banking system wouldn't really have an impact on our money supply, and we wouldn't even need to be talking about banks right now. And then finally, let's say we've got a fractional reserve banking system that only keeps the minimum 10% it's required to in reserve. What happens here? And the answer will be radically different from cases 1 and 2. So let's start at the beginning. We print a crisp new $100 bill, fly over the United States, which does not have a banking system, and throw it out the side of our helicopter. Some lucky person fetches the $100 bill and now holds $100 in currency. But there are no banks, so they will continue holding this as currency, which means when we add up the money supply of this country, there's $100 floating around that we put in, or if you want to think of it as $100 additional dollars floating around. And even if they spend it, they buy themselves a bicycle for $100, there's still a total of $100 in circulation. It'll be spent by the person buying, received by the person selling, no change in the total. That's the basics of where money comes from. But banks matter. So let's go ahead and introduce banks now. But we'll start with banks not like they really work. We'll start with banks that keep everything in reserve. So we get in the helicopter, fly over the United States, throw out the $100 bill. Somebody fetches the $100 bill, runs to their bank, and deposits all of it into this bank. Let's have a look at the T account of this bank now. In liabilities, it has $100 deposited in the checking account. Then over on the asset side, it has to keep all $100 in reserves, which of course means it cannot make any loans. Let's count out the money supply in this example. I would count this as $100 in a checking account. That counts, that's part of the money supply. I would count it as $0 of currency in circulation. Let me explain that for a second. You're probably thinking, hey, the $100 bill, it's sitting in the vault of that bank in reserve. Why am I not counting that? Well, money that's in reserve with the bank, we don't count as the money supply because it isn't in circulation. Basically, when we look at our 3 functions of money, we've got store of value. What's in the reserves is still keeping value. We've got unit of account. What's in the bank reserves, we can still count it. It still does those 2. But medium of exchange, if it's in reserve with the bank, it cannot currently be spent. So the reserves, not part of the money supply. Let's add it up then. $0 currency plus $100 checking deposit. The money supply is $100. Or in other words, the fact that a bank exists changed nothing about the size of the money supply in this example. And this of course also works if our depositor makes a withdrawal. Let's say they take $30 out of their checking account. I would now count the money supply as $30 currency plus $70 deposits, still $100. No change. But now comes something a little more realistic. What if we have a fractional reserve banking system? So let's restart this story one more time. We print a $100 bill, fly across the United States, throw it out the side of the helicopter, lucky person fetches it, deposits it in the bank. The bank now has $100 in deposits, $100 in reserves. But it's a real bank. It's allowed to make loans. And let's say it makes the very maximum loan it's allowed to, 90%, since it has to keep 10% in reserve. So look really closely at the assets of the bank now. We're going to change this mix from $100 in reserves, $0 in loans, to $10 in reserves, $90 in loans. This is a game changer. Let's count out the money supply. First, there's $100 sitting in a checking account. It can be counted, it keeps its value, and our depositor can write checks against it. Definitely part of the money supply. But secondly, we had somebody take a $90 loan. And why did they take a loan? Well, to buy something, of course. Can they? Can they take these borrowed $90 to a store and spend them? Or will the storekeeper say, well, this looks like borrowed money, I'm not going to accept that? Of course not. These $90 can be counted and spent and keep their value just like anything else. So they too count as money. So if we look at the money supply of this country, even though we only put in $100, because this bank exists, the money supply grows to $190. More money exists than we originally put in. Let's look really closely at what happened here. The money supply grew when the bank made a loan. If it helps you think about it, loans basically allow money to multiply, allow multiple people to use the same base money that was first put into the system. That doesn't mean that magically this economy got richer. The borrower might have $90 they borrowed as an asset, but they also owe $90 to the bank. So banks, they create money, but they don't create wealth outside of the actual function of the bank of making loans more accessible and so on and so forth. And so far we've only talked about one bank. That $90 loan, it's going to be spent on something. And if the person who receives the $90 deposits this at another bank, let's call it Second National Bank, what happens to that bank's T account? Well, it's got $90 in deposits, $90 in reserves, so it thinks to itself, I should make a loan to turn a profit. Let's go ahead and loan out 90% of what's on deposit with me, the maximum I can. So that's another $81 loan. So now we have $100 in deposit at the first bank, $90 in deposit at the second bank, and $81 cash in circulation. Money supply has grown to $271, more than twice what was originally put in already. And for the purpose of discussion here, I'm saying it's deposited at the second bank. It doesn't actually matter. The $90 could be deposited at the first bank, and again would count as reserve, and the first bank could make that same 90% loan. And let's keep going, because of course, the $81 here can now be deposited at a third bank, or the first or the second bank. The third bank says, hey, I've got another $81 in reserves. Let's go ahead and loan out 90% of that. There's another $73 in circulation, and so on and so forth. with every additional deposit, an additional 90% in money supply can be created. So how big is this effect? Well, if it plays out to the maximum, meaning every bank loans out the maximum it can, every borrower immediately spends that money, whoever receives that money immediately deposits everything in the bank. The absolute maximum that would be possible in this example would be that by the time the multiplication is done, we would have $1,000 in money supply. We would have put in $100, but the money supply would have grown by $1,000. So this original $100 we put in, where it all ends up is as reserves of the banking system. And these reserves could support 10 times as much money being created through the lending process. So while it's true that the Federal Reserve is the only entity that can create new money out of thin air, so to speak, most of the money we interact with in our day-to-day life actually comes from the existence of our banking system. Now, in our specific example here, this effect had a power of 10x. $100 in reserves created $1,000 of money supply. But of course, that depended on how much the banks were keeping in reserve. So in general, the size of this effect is referred to as the money multiplier of our economy. How much money our banking system creates for every dollar in reserves that the Federal Reserve adds. Or it works in reverse as well. When the Federal Reserve removes money, this reduces the reserves of our banking system, and the money supply will fall by the same money multiplier. It turns out, calculating the size of this money multiplier is very easy. It's 1 divided by the reserve ratio of our banking system. It's 1 divided by R. It's the reciprocal of the reserve ratio. So in our example, our banks were keeping their reserve ratio at the legal minimum, 10%. If we take 1 divided by 10%, the reciprocal of 10%, well, 10% in decimal notation is of course 0.1. The money multiplier in our example was 10. And you notice that? Because the $100 in reserves added to the system created 10 times as much, $1,000 in money supply. That's 10 times as much, including the initial money that was put in. The money multiplier already includes that initial $100. You don't have to add that back on at the end. Now, how powerful this money multiplier is obviously depends then on the reserve ratio of our banking system. If our banks keep less in reserve, more money supply is created. But really, so far we've discussed banks from the perspective of the money supply, which means we had this really oversimplified balance sheet. Loans, reserves, and deposits. Now, of course, at the end of the day, banks are businesses. So while on the assets, they might have reserves and loans, and they can also put their money into securities such as stocks and bonds, over on the liability side, it isn't just deposits. It isn't like everything that the bank does for fundraising is only done by checking and savings accounts. Banks can also borrow money, just like any other business. They can issue debt. And of course, most importantly, they can issue stock as well. Somebody owns that bank, right? When the bank makes a profit, where does that extra money go? To the owners. This is referred to as owner's equity, or when it comes to banks specifically, as the capital of a bank. So having a look at a bank's balance sheet, when we look at all the resources it uses, part of that, of course, comes from the owners, which we calculate as all the assets of a bank minus all the liabilities other than the owner's equity. Let's have a look at such a balance sheet in order to understand the concept of leverage and why this makes banks relatively vulnerable to changes in the values of its assets. So leverage in general for a business refers to the idea of using borrowed money to amplify the return on equity of your business, the return on bank capital in our example of the banks here. But because banks operate a lot by using their deposits, they are operating with a lot of leverage. Let's look at an example of a more realistic balance sheet to calculate this. So here we are with First National Bank again. Over on the asset sides, this bank has reserves, it has loans, and now as a new item, it can also hold securities such as stocks, bonds, collateralized debt obligations, and so on and so forth. Then over on the liabilities, most of these assets come from the deposits of the depositors, but our bank also has some debt, and finally, it has capital, the equity of its owners. Notice, both sides add up to $2,000. Assets have to equal liabilities. So the first thing we're going to do here is calculate the leverage ratio of this bank. We take all the bank's assets, $2,000, and divide that by how much of those assets comes from the capital of the bank, $100. So take 2,000 divided by $100, the leverage ratio of this bank is 20. What that means is, for every $20 of assets this bank has, 1 is the owner's money, 19 of those dollars is borrowed money, where I'm using borrowed both to refer to the depositor's money and the debt that this bank has. Leverage ratio is 20. This means if the value of the assets of the bank changes, in other words, it has those loans, what if the value of those loans goes up or down? And it's holding those securities such as stocks and bonds, what if their values goes up or down? Let's say the bank assets gain 5% in value. So they go from $2,000 to $2,100. We take the assets, $2,100, subtract the other liabilities, and we find that bank capital has gone from $100 to $200. Or in other words, the return for the owners is an increase of 100%. Even though the assets only went up 5%, the return to the owners is 20 times that, because the leverage ratio is 20. Works in both directions. Let's say some of the loans of the bank go bad. Maybe some mortgages go bankrupt, the homeowners don't repay. If the assets lose just 5% of their value, they go from $2,000 to $1,900. So we take the assets, now $1,900, subtract the liabilities. The bank still owes the depositors, still owes its debtors. That means the bank capital has gone from 100 to 0. The bank owners have lost everything. Negative 100% return on equity. Again, the effect on the capital was 20 times the change in asset value. And what if it goes further than that? If the assets of the bank lose more than 5% in value, then the assets will be worth less than the liabilities. The bank will be insolvent because it no longer can repay what is owed to the debtors and the depositors. That is the power of leverage. Using 20 times leverage as an example, more than 5% loss on the asset side, and the business goes under. Because of this, because of how sensitive banks are to changes in the value of their assets, governments impose capital requirements on banks. Basically, they say there's a minimum amount of your assets that has to be backed by the owners. You can also think of this as a limit on how much leverage banks can engage in, since leverage is calculated as value of assets divided by bank capital. And this is supposed to make our banking system less risky. We saw this play out in the 2008-2009 financial crisis. The value of banks' assets fell during the mortgage crisis, which meant they now were losing so much of the bank's capital, they had to build that capital back up, and they could not afford to make any more loans. They already had too much outstanding relative to their capital. So they stopped lending. This phenomenon, a credit crunch, is what makes financial crises such a powerful negative effect for an economy as a whole. Because without borrowing from banks, it becomes very difficult to borrow money. All right, with that detour through our banking system, let's return to the Federal Reserve and how it controls how much money is in circulation. So far, I've described it as they print currency, get in a helicopter, and throw it out the side of the helicopter across the United States. Clearly, that's not how it actually works. If there was a Federal Reserve helicopter distributing free money from the sky, you would have heard about this. Instead, the primary mechanism that the Federal Reserve uses is called open market operations, or OMOs for short. That's why that committee that controls how much money is put into or taken out of our system is referred to as the Federal Open Market Committee, because they engage in open market operations. So you can think of the Federal Open Market Committee as having a magic bank account. Imagine you could log into your online banking, but when you look at the balance in your bank account, that field is editable. You can click on it and put in any number you want. Fundamentally, that's the power a central bank has. They can create and delete money. But that money is just sitting in their bank account. They now have to put it into circulation. And just randomly distributing it, such as by helicopter, doesn't look very fair. So what they do instead is they buy assets with this money. That way the new money is in circulation, but they receive an asset of equal value in return, so they are not just making random people in our economy richer. Most of the time, when the Federal Reserve does this, they buy US government bonds, so-called treasuries, on the open market. Sometimes, in dire economic straits, the Federal Reserve will also put new money into circulation by buying other types of financial assets. For example, during the 2008-2009 financial crisis, they also bought some mortgage bonds in addition to US government bonds. But that's unusual. That'd be unconventional monetary policy. So they can do this in two directions. First direction, if they want to increase how much money is in circulation, they buy government bonds to put those new dollars in circulation. So in other words, think of this transaction not in terms of the bonds, think of it in terms of the money. When the Federal Reserve buys something, somebody else now has more money. But as we learned when looking at our banks, this money will be deposited in our banking system, increasing its reserves, and then the process of the money multiplier kicks in. So the actual increase in the money supply will be greater than the number of dollars that the Fed used to buy those government bonds. This is why the money that the Fed spends to buy bonds is sometimes referred to as high-powered money, because it'll still be multiplied by the existence of our banking system. It's easier to think of this process in terms of increasing the money supply, but of course you can use the same process to reduce the money supply as well. If that's desirable to keep the value of our money stable, the Fed takes some of the bonds it already owns and sells them on the open market. Whatever money it receives for these bonds, it then deletes out of its bank account. And of course, however much in bonds it sells, the actual decrease in the money supply is greater than that. You have to multiply that by the money multiplier. The money multiplier affects both increases and decreases in the money supply. So this is the primary way in which the Federal Reserve regulates how many dollars exist to keep their value stable. But it has two other major tools in order to make this process work. One of them we already discussed. The Federal Reserve can also set the reserve requirement, the minimum of how much banks have to keep in reserve. So you could imagine if the Federal Reserve wanted to increase the money supply, it could allow banks to make more loans by reducing the reserve requirement. Or if it wanted to clamp down on lending, it could increase the reserve requirement. While the Federal Reserve has this power in order to have better control over the money multiplier process, it very rarely changes the reserve requirement. Because as opposed to open market operations, this is a very blunt tool that would cause big changes in the money supply and how banks operate very quickly. It's disruptive. So think of this more as an emergency measure. And this is not the only emergency measure the Federal Reserve has. The Federal Reserve also has the ability to make loans to banks in order to make sure they've got more money available and don't go under. Confusingly, somewhat, these loans are referred to as the discount window of the Federal Reserve, and the interest rate that the Fed charges banks on those loans is referred to as the discount rate. You'll get used to the term. So you can imagine, if banks are running low on reserves and the Fed wants to put more reserves into the banking system, for example, they did this in 2008 during the financial crisis, they could invite the banks in to borrow money very cheaply from the Federal Reserve, which in turn will bolster the reserves of the banks so that they can make more loans. Or vice versa, if the Federal Reserve was worried that this could get out of hand, it could raise this interest rate that banks have to pay and make borrowing from the Fed very unattractive so that banks reduce how many loans they make. Again, this is not something for day-to-day operations, but it's a good emergency measure to keep banks from collapsing. This is why the Federal Reserve is also referred to as the lender of last resort for our banking system. So this is referred to as the discount rate. There is one more important interest rate associated with the Federal Reserve you need to know about. The discount rate is the interest rate when banks borrow money from the Federal Reserve. But banks also borrow money from each other. Banks have to keep a minimum of reserves, the reserve requirement. But because on any given day, someone might go to a bank and withdraw a lot of money, on any given day, some banks in our economy might be sort of in danger of dipping below their required reserves. No big deal. What those banks do is they go to banks that have extra reserves, because that's the default situation for most banks, and they borrow what they need in reserves from those banks that have extra until the bank in question can readjust its balance sheet. The interest rate on these very short-term loans, typically they are only for one day, those loans, is referred to as the federal funds rate. So one more time. If a bank borrows from another bank, federal funds rate. If the bank borrows from the Fed, discount rate. You'll get used to these terms. Now, when the Federal Reserve makes monetary policy, so specifically as we've now learned, when the Federal Open Market Committee conducts open market operations, this changes the money supply in our country. But the way the Federal Open Market Committee decides how much to change that money supply is that they often target the federal funds rate. They change the money supply until what banks charge each other hits a certain range that they are aiming for. And if this interest rate's a little bit too high, the Open Market Committee adds money until the interest rate comes back down, or vice versa, withdraws money until that interest rate goes back up into the range. That's because while the federal funds rate is a very specific and technical rate, it's the interest rate that banks pay. Of course, what banks pay is closely correlated with what many other entities in our economy pay for credit. To finish up, let's look at a real-world example of this, how the federal funds rate affects other interest rates in our economy. Here's a graph of the federal funds rate across 40 years in blue. You can see since the 80s, the federal funds rate has been decreasing, interest rates have been lower in our economy, especially during recessions, which are here represented as gray bars. Now the red line is an interest rate that's referred to as the prime rate. This is the interest rate that banks charge their best clients. And you can see it follows closely the federal funds rate. What banks pay in interest, the federal funds rate, plus some markup, represents what, for example, businesses have to pay banks to borrow. And on the consumer side, this has an impact as well. The green line is the average interest rate on a 30-year fixed mortgage in our economy. Now, that's a very different type of interest rate. The blue line, the federal funds rate, that's an interest rate for borrowing money for just one day, bank to bank. The 30-year mortgage is an interest rate for 30 years that's fixed. But even that, dramatically longer interest rate. We're really going from one of the shortest interest rates in our economy to one of the longest. Look at that green line. Even it is affected quite a bit by where the federal funds rate target is. And that concludes our discussion of the monetary system. I will see you next time.